Welcome back. It's Finance Friday, another special edition of Money Girl, where I answer your burning money questions. Today's topic is a good one. It comes from Lisa, who says, I'm 29 years old and getting married this summer. My fiance and I have good jobs and contribute a little to our 401ks. We're renting a place, but would like to buy a home someday. Since we don't have much savings for a down payment, should we stop putting money in our retirement plans and put it in savings instead? Or is trying to buy a home that's affordable right now just too difficult? Thanks for your question, Lisa. Buying a home is the largest purchase that many people ever make. This podcast will review how buying a home might fit your overall financial goals and tips for making it as affordable as possible. Again, I appreciate you downloading episode 921 of the Money Girl podcast. I'm Laura Adams, an award-winning author, speaker, spokesperson, and founder of The Money Stack. That's my Substack newsletter. You can subscribe to the newsletter for free or support the show as a paid member and get access to live educational events. You can learn more and connect with me at lauradadams.com. That's also where you can email your money question, learn more about my books and courses, and of course, sign up for The Money Stack. You can also record a brief question or comment on our voicemail at 302-364-0308. I hope to hear from you soon. If you're like Lisa, wondering if becoming a homeowner is still a worthwhile goal as prices and mortgage interest rates rise, I'll review some of its primary pros and cons to consider. Then we'll discuss how to buy an affordable home if and when it's right for you. So let's go through 5 reasons why buying a home can improve your life and finances. Number 1, you build equity. Home equity is the difference between a property's market value and what you owe on it. For instance, if your home gets appraised for $400,000 and your mortgage balance is $300,000, you have $100,000 in equity. You could sell the property, pay off the mortgage, and walk away from the deal with about $100,000 in your bank account. When you have a fixed-rate mortgage, each payment is made up of principal and interest in amounts that change monthly. Therefore, each payment helps you grow a little richer as you reduce the outstanding loan balance by a slightly larger amount, and that whole process is known as amortization. If your home's market value is steady, you increase your equity with each monthly mortgage payment. The second benefit of buying a home is that you typically get appreciation. Many areas of the country saw huge price appreciation during the pandemic. I'm sure you guys remember that. While housing inflation has slowed, prices are still rising. And that's great for homeowners because it boosts their equity and resale value. For instance, if you buy a home for $400,000 and its market value increases to $550,000 over time, you have $150,000 additional equity. Historically, real estate has been an excellent long-term investment, but there's no guarantee that a home's value will go up or that it will appreciate as quickly as you'd like. For instance, you probably lost money if you bought a home in 2007 and had to sell it during the 2010 recession. But according to the Case-Shiller U.S. National Home Price Index, home prices in January 2025 were up about 4% over the prior year. But if you bought a home at the beginning of the pandemic, the appreciation since then has been an average of 53% nationwide. The third benefit is that you get an inflation hedge. When you have a fixed-rate mortgage, your payment gets locked in for the term of the loan, like 15 or 30 years, no matter what happens to interest rates or the economy. In contrast, rents may increase during periods of inflation, as we've seen recently. But a fixed mortgage can't go up, so owning a home actually becomes more affordable when prices rise. Number 4, you may have a lower monthly payment. While home prices continue rising, it can still cost less than renting in many areas of the country. That's especially true if you don't live in a big city like New York or San Francisco, where home prices are notoriously expensive. For example, buying a $400,000 home with a $300,000 30-year fixed-rate mortgage charging 7% interest would make your monthly payment about $2,000. Even with additional costs such as homeowners insurance, property taxes, and perhaps private mortgage insurance or PMI, it can still be less than renting a comparable home. And number 5, you get tax benefits. Homeownership comes with tax benefits that reduce your annual tax liability. The mortgage interest tax deduction allows you to deduct a limited amount of interest that you pay on a primary and a secondary residence. You can deduct interest paid on up to $750,000 of mortgage debt if you file taxes jointly, or up to $375,000 if you file taxes as a single. Another significant tax perk for homeowners comes when you sell a home, which is the capital gains tax exclusion. It allows you to avoid paying tax on up to $500,000 of profit if you file joint taxes, or up to $250,000 of profit as a single. However, you must have lived in the home for at least 2 of the previous 5 years before the sale to qualify for the exemption. Now, let's talk about the benefits of renting a home. Here are 5 reasons being a renter can improve your life and finances. Number 1, you pay less up front. A massive pro for renting is not having many upfront expenses compared to buying a home. Mortgage down payments vary depending on your income, credit, desired property, loan type, and lender, but typically range from 3 to 10% of the purchase price at a minimum. In addition, you also must make an earnest money deposit with your purchase offer and pay closing costs like lender fees, attorney fees, appraisal, survey, inspections, title insurance, homeowners insurance, and other expenses customary in your area. The second pro for renting is that you may have a lower monthly payment. As I previously mentioned, where you live is a significant factor in whether renting or owning a home costs less. However, renters get to skip many expenses that homeowners can't, like repairs and maintenance. If you live in an expensive city, renting may be much cheaper than buying a comparable property. Number 3, you have flexibility. Being able to pick up and go for a promotion with your company or for your family's needs could go a long way toward improving your life and finances as a renter. If you want to pull stakes as a homeowner, you're usually stuck until you sell the property, or you find a reliable tenant to help you pay the mortgage. Depending on the economy and the housing market, that could be easy or difficult. Number 4, you're protected from market downturns. Recessions and real estate bubbles may not affect renters as much as homeowners. Renters may come out ahead if rents go down when the economy struggles. And 5, you may get better amenities. Tenants with amenities like a clubhouse, pool, exercise room, theater, or rooftop lounge could pay less than owning a comparable home or paying for those amenities separately. Even renting a home with lots of square footage, a garage, pool, and a large yard could be a lot less than buying it. So the extras you get as a renter can significantly contribute to a lifestyle you enjoy that wouldn't be available to you as a homeowner. So getting back to Lisa's question, like many issues in personal finance, the answer to whether you should be a homeowner is it depends. Your financial situation, goals, and lifestyle are unique, and there's no right or wrong answer. If you decide to become a homeowner, a good rule of thumb is to be sure you'll live there for at least 5 years. That's because you never know how long it could take you to sell the property. If buying a home has more advantages for you than renting, and you're willing to put down some roots, owning an affordable home is a terrific goal. But preparing your finances to buy a home isn't easy, and it could take years. As Lisa mentioned, you likely have other goals, like retiring. You also may need to build an emergency fund, buy a car, take a vacation. So where does buying a home fit in? Well, I'm going to encourage you to start with your most critical goal, which for most people is funding retirement. If you regularly invest about 10% of your gross income in a retirement plan, like a 401k, or you max out an individual retirement account or IRA, you're in a good position to begin saving for a home. If you don't have a healthy emergency fund, you could temporarily reduce the amount you invest for retirement, maybe take it down to 5% of your income. But it's critical not to stop investing. Plus, a home purchase should never deplete your savings. Once you become a homeowner, it's even more crucial to have a cash cushion for unexpected expenses, like home repairs not covered by insurance. If you can continue investing 10% or more of your income for retirement and save for a home simultaneously, that's ideal. Yes, that means it might take longer to accumulate enough, but you'll be in a far better financial position when you do buy a home. If you're unsure how much money you'll need for a down payment and closing costs, speak with an experienced real estate agent in the area where you want to live. They can help you understand the price of homes, insurance, property taxes, homeowners association dues, and typical closing costs, and they can recommend mortgage professionals and other service providers. A knowledgeable agent is your greatest asset in any real estate deal. They can help you understand a seller's priority, like getting the highest price, delaying a closing, leaving their furniture, or getting a quick sale. Use a seller's motivation to negotiate a win-win transaction. To get the least expensive financing offer, make sure your credit is in good shape before you start house hunting. For instance, don't open any new credit cards or loans for at least 6 months before you plan to apply for a mortgage. The higher your credit scores, the better your mortgage terms will be. Your leverage to negotiate the price of a home depends on what's happening in the local market. If it's hot and you've got many buyers and few homes for sale, getting a deal may not be possible. However, if you're willing to renovate a property, consider buying a home that's discounted because it needs repairs, or maybe it's outdated or has an undesirable floor plan that you could modify. Just be sure to get several estimates from contractors so you understand if a discount on a home is significant enough to cover your future costs. And remember that submitting an offer on a home is not a commitment to buy it. Most purchase offers include contingencies like getting a satisfactory home inspection, a satisfactory pest inspection, a seller disclosure, an appraisal, and a mortgage. You can back out without penalty during the due diligence phase if you find something unsatisfactory about the property that's covered in your contract. Before you begin touring homes for sale, I encourage you to make contact with several mortgage lenders or brokers for pre-approvals. Brokers have access to multiple lenders, and they can connect you with the best lender for your situation. Submitting pre-approvals with a purchase offer can give you a leg up over other interested buyers. The mortgage down payment you'll need depends on the type of loan you get. For instance, an FHA loan allows as little as 3.5% down, which is excellent when you have limited funds. However, an FHA loan may charge a higher interest rate than other options. A conventional mortgage may charge a lower interest rate, but typically requires you to pay at least 10% down. And if you pay 20%, you avoid paying PMI, private mortgage insurance, which could save hundreds of dollars monthly. So, paying 20% down is a good target. When you have a home under contract, that's when it's time to start shopping around for homeowners insurance. An easy way to cut your premium is by raising your deductible. But that means you'll need more savings and you'll have to cover smaller expenses out of pocket. Many insurers offer discounts for safety features in your home, like having a security system, storm-proof windows, hurricane shutters, and a newer roof. You can also pay less when you bundle policies with the same company, like getting your home and auto insurance from the same company. In addition, other factors like being married, working in certain fields or occupations, living near a fire station, having good credit, and not smoking can cut home insurance costs depending on what's allowed in your home state. Ask your insurance provider or broker what discounts are available so you get as many as possible. Once all your contingencies are satisfied, you should receive your official closing statement a day or two before a home closing. You want to review it carefully to familiarize yourself with the seller's and the buyer's fees and get any errors corrected immediately. Make sure the statement reflects everything you negotiated with the seller and discussed with your lender and your home insurer. If buying an affordable home is one of your financial goals, preparation is the key to achieving it. Rushing to buy a home too early is just a recipe for financial disaster and stress. But if you slowly build your credit, your savings, and your knowledge about home buying, you'll be in the best position to become a homeowner when the time is right. Lisa, I want to thank you for your question and hope this show has given you and your fiancé some things to think about. Before we go, a quick reminder to subscribe to The Money Stack. That's my Substack newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. When you sign up, you'll get my Money Success Toolkit, which is a free gift. It includes the exact same templates I use to manage my money. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team that works on the show. Steve Rickyberg audio engineers the podcast. Brandon Gachus is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. And Nathaniel Hoops is our marketing contractor.